Thank you very much to once again welcome you to Mezzone African Motives. Ensure that you are going to uh, listen to the presentation from the start to the end and make sure that you are going to share with those who are concerned, as well as we are to make sure that we hit the subscription button. So today, I am going to offer you Economic Management Science Grade 8, Term 3. The topic is forms of business ownership. So we're first going to start with the terminology, the language that is used under this topic, forms of business ownership. So the first term that we are to know is capital. So as we are told that the capital is the money provided by the owner to start up the business. Start up the business. Capital is used to buy assets such as land and buildings, vehicles, machinery, and equipment. So, in short, capital refers to financial resources. It refers to financial resources. That's capital. As you are told that capital is used to buy assets such as land, buildings, vehicles, machinery, and equipment. So capital refers to the financial resources or assets to fund a business. To fund a business. That's in short what we can say about a capital. So it's the money that is going to be provided by the owner so that he can set up the business. So that is a financial resource. It can be a money, as we are talking about, a financial resource, or it can be the assets like we are told here to be able to fund the business. Now we have a legal personality. So now we're told that it is the legal right of a person or business to own a property. It is a legal right of a person or a business to own a property, enter into contracts, or sue or be sued. That's what legal personality means. As a person or as a business, you've got the right to own a property. You've got the right to enter into contracts, but you can as well be sued. You can sue someone or you can be sued. That's why it says it's a legal personality. So in short, with legal personality, we are saying it refers to the concept that business has its own legal entity separate from its owners. So in short, it says it refers to concept that business has its own legal entity. Business has its own legal entity. Legal entity separate from its owners. Separate from its owners. So if anything happens with the business, maybe now the business goes bankruptcy, or business owes the suppliers, now they are to pay the debts. So what is going to be sued is the business, not the owner of the business, because it is a legal entity. It is separate from its owners. So that is what do you mean when we are saying, when you're talking about legal personality. That is in short. So now we can even make an example under this legal personality, where we can say a corporation can enter into contracts, own assets, and sue or be sued in its own name rather than in the name of its individual owners. Rather than in the name of its individual owners. That's what the legal personality means. Because a corporation will be entering into a contract, owning the asset, and it can sue or be sued in its own name. So leaving out what? The members, individual members in that corporation. Because the business is separate from the owners. That is why it says if a business is a legal person, it is seen as a legal entity. That is why we're talking about separate from its owners. Now we come to continuity as another term that we have to know and familiarize ourselves with. It says is the ability of the business to continue operate separately from the owner. So even if the owner dies, the business is still going to exist. The business is still going to continue to operate. That's what, in short, it means when we talk of continuity. It refers to the ability of business to continue operating despite changes in ownership or management. So that's what continued means. Refers to the ability of the business, ability of the business, ability of the business to continue operating. To continue operating. To continue operating despite changes that might happen in the ownership or management. That is that. So we can make an example where we're saying a company continues to operate and thrive even after the founder retires or passes ownership to a new generation. So it means we are guaranteed that the business will continue. Also, we have if a business has no continuity of existence, the business will stop existing if the owner retires or dies. This one is straightforward. That is when the business has what? Has no continuity. Without continuity, a business may cease or exit. That's when you are talking about no continuity. The business may cease or exit. Business may cease or cease to exist. Cease to exist. That's what it means. If the owner dies or leave the business, so that is ensure that the business depends only on the owner. So that's when you're talking about sole proprietor or sole trader. May dissolve if the owner passes away, unless there is a plan in place for succession or transfer of ownership. So that is what we mean. Now we are moving on. We are moving on. Where now we are talking about if a business has continuity of existence, the business will continue operating, or that is the same point that we have talked about. A business that has legal personality has continued. We talked about, but now what is important is to talk about liability. They are saying is the owner's responsibility for the business, the owner's responsibility for the liabilities which is that of the business. So liability is the responsibility or the liabilities to pay off your debts. So it refers to the financial responsibility of business for its debts as well as obligations. So this one, we are talking about financial responsibility, talking about financial responsibility, financial responsibility of a business. Financial responsibility of a business for its debts. For its debts, as well as obligations. That is done. Then we have limited liability. It means that they cannot lose their personal belongings if there is not enough assets in the business to pay for debts of the business. That is when you're talking about a limited liability. Even if the business can fail to pay off these debts, the belongings of the owners are not going to be into danger. They are not going to be taken off to pay off the debts because it is a limited liability. Because it's the limited liability. That's what it means when you're saying you're talking about limited liability. If owners have unlimited liability, it means that you could lose their personal belongings if the business pay back all this. So if business now is unable to pay off its debts, now it means the personal belongings of the owner are going to be taken to pay off the debts because it has a unlimited liability. Now we are moving on to taxation. We are moving on to taxation. Let's hear what taxation is all about. So with tax, we are told that taxation, depending on the legal person of the business. So it depends on the legal person of the business. Either the owners or the business itself will pay tax on income or profits that are made by the business. So the owner of the sole trader and partners of a partnership are responsible to pay tax on their personal income. So for the sole trader, they pay tax with their personal income, not with their business profits. They are not paying tax with business profits, but with their personal income. But with closed corporation and companies, these are seen as legal entities. These ones are seen as legal entities. Therefore, these businesses are responsible to pay income tax on profits made. So here with corporations and companies, the tax are paid by the profits, revenues of what? Of the businesses. So unlike with sole trader as well as partnership, where the partners and sole trader to pay the tax with their personal income. So this one now we're told again, tax is paid at a fixed percentage of 28% on profits and a secondary tax of 10% on profits paid out to members or shareholders. So the members of the company or the shareholders in the company, they are going to pay 10% of the profits that the got from the business, or the profits that they were paid out by. So they have to take or part ways with the 10% of their profits that they were paid out from the company. Hope we are still together and hope we are still on one page. So in short, when we talk of tax, we refer to the payment of tax on business income as well as profits. Now we come to the description of the form of business ownership. Description of the form of business ownership. Here we are going to talk about a sole trader. We are going to talk about a sole trader. We want to know the characteristics of what? Of sole trader. Characteristics of sole trader. So a sole trader, we are going to talk about the number of owners. So normally a sole trader is an organization that is formed by one person. What owners are called there is called what? The owner. The only one person who established the business. Amount of capital that is to be contributed. Contributes own capital from his or her savings. From his or her savings. Or from his pension. Or he can even borrow it from friends. Now we are talking about the source of capital, where he can get capital from. The name requirements. No restriction to the name. So the name is the easy. Like we are told that Tandi's Baker, you can just give it any name. So that is as easy as like that. There are no restriction to the name. Legal status, not a separate legal entity. Not a separate legal entity. So it means if the business found itself into a debt, the personal belongings are going to pay off what? Those debts. Because the status of the business is separate. It's not separate legal entity. So that is that. Liability for debt of the business. Unlimited liability. Creditors can take the personal assets if the business is in debt, like I said. Because a business is not separate from the owner. So creditors, when they see the owner, when they see the business, they see the owner. That is why they can take even the assets to pay off the debts. That is what it means when you're talking about also unlimited liabilities. The owner's personal assets are at risk. That's what it means. Owner personal assets are at risk. Owner personal assets are at risk. Owner personal assets are at risk in case business incurs debts or liability. In case business incurs debts or liabilities. That's what it means. Now we come to the formation of the business. Very easy form. As no registration required except perhaps a trading license of the business. That's how easy it is to form a sole trader. It's very easy to form as there are no formal registration. There are no formal registration. There are no formal registration. No formal registration. Unlike companies, Sole trader do not need to register with authorities. Sole trader do not register with what? With authorities. So the only trading license. That's what can be required from a sole trader. Division of profits. All the profits belong to the owner. So it means the owner enjoys the profits alone. Owner enjoys profits alone. Enjoys profits alone. Okay, I wanted to write it in here. Owner enjoys profits alone. We are talking about sole trader and the division of profits. So where we are saying the owner is going to enjoy profits alone. Enjoy profits alone. Documentation. No documents are required. There are no documents that are required in sole trader. There are no documents that are required in sole trader. So now we are moving on to advantages as well as the disadvantages of this form of business ownership. Let's make sure that we are still together. We are still listening. We are still paying attention to the presentation that is given. The presentation that is given. Now we are going to talk about the impact of sole trader. So when you talk of the impact, you know very well we're talking of what? Pros and cons, advantages and disadvantages. Now, the first advantage that we are given here is owner makes all the decisions. The owner makes all the decisions are made by the owner himself, and they become fast because he's making those decisions alone. So that is that. Requires a little capital to start. So it is easy to start what? A sole trader, to start that business, sole trader, because it requires what? Little amount of capital. So it is easy to start it. It is easy to start such a business. It is easy to start it as it requires a little capital. So that is why we are saying it is easy to start such a business. All profits belongs to the owner. Like I've said, that the owner is going to enjoy profits alone. It's going to enjoy profits alone. Simple management structure. So if sole trader, the structure is very, very, very simple. With sole trader, the structure is very simple, unlike with companies as well as the corporations. So sole trader structure is very simple. So now we are told about can easily adapt to the needs of the consumer. Can easily adapt to the needs of the consumer. So because it's a sole trader, he have a direct contact with his customers. So it is easy for him or her to attend easily to the needs of the consumer. No legal processes and requirements, because Only what is needed there is what? A trading license. From there are no legal processes and requirements. Unlike in the companies where we needed to hand in memorandum of association, the articles of association, but with this one, there are no legal processes and requirements. The assets of the business belongs to the owner, because the business is started by the owner alone himself. There is no personal encouragement and personal conduct between owner and customers. There is no personal encouragement and personal contact between the owner and customers. So now let's hear about the disadvantages of sole proprietorship. Disadvantages of sole proprietorship. So now we are told that unlimited liability, which means the owner is responsible for all debts incurred. So the personal belongings, now this is where they are going to be taken to pay off debts should the business find itself incurring debts. So that is that. So let us now move on to another point under the disadvantages of so the cash flow is often a problem, which means limited financial resources. Limited financial resources. So it means that sole traders often rely means that sole trader often rely on their own savings. They rely on their own savings or personal loans. Personal loans, which can limit their cash flow. That is why we are saying cash flow is often a problem under sole trader. Growth of business can be restricted due to lack of capital. So the business is going to find it difficult for it to expand, because now the capital that is contributed is very little. So there will be no expansion. The business is not going to expand due to lack of capital. No legal entity, as you know, that there is no legal entity under a sole trader and no continuity. If the owner dies or retires, the business means also is going to cease to exist. So if ever owner retires or dies, if the owner dies or retires, the business is going to cease to exist. Difficult to attract highly skilled and knowledgeable employees because the business is very small. So it simply says even the compensation, how is going to compensate the employees, they're going to pay it with little salaries. So that won't attract highly competent, skilled employees. That's what that point means. The owner is responsible for providing all the capital needed. Unlike with other forms of business ownership like partnership, companies, corporations, they are sharing what? The capital. So here it is the responsible of what? Of the owner alone. Is the one to contribute the capital alone. If the owner does not have enough knowledge or experience, the business may fail because of there will be no quality. Decisions that are going to be made are not going to be of quality. So if he finds himself with unnecessary skills to operate the business is going to be into a problem, because now the owner will be without necessary skills to operate the business. So if he was in the partnership, companies, corporations, so it means they were going to share their skills. So if the other one was going to fail, the other one was going to help with skills. So here, if he failed himself because he's just alone, that's the end of the business. Now I'm moving on to another form of business ownership. Now we are under partnership. We are under partnership now. So with partnership, we are going to talk about the number of owners. So this one is owned by minimum of two. Minimum of two, but there is no limitation on the number of partners. But it's supposed to start by two people. That is the partnership, how it is formed. Owners are called what? The partners. The amount of capital that is contributed. Partners contribute capital in the form of cash or assets or skills. Some they can come up with skills, or they can come up with their assets or cash. We can partner with cash, or we can partner with assets or the skills that we are going to contribute with. The name requirements, the same as a sole trader, no restriction to the name. Can this and impulse be carried? Okay. Legal status, same as sole trader, no separate legal entity. Should the business find itself into debt, the partners' belongings are going to pay off that debt. Remember, even the partners, they pay tax themselves with their personal income, because the legal status of this business is not a separate legal entity. Coming to the liability for debt of the business. Liability for the debt of business. Unlimited liability. Partners are jointly and severally liable for all debts, like I have said. Formation of the business only needs a trading license from the local authority. So the formation is very simple, just like sole trader. Division of the profits. With this one, partners share the profits according to their, very important, to their partnership agreement, or what you call partnership deed. Partnership deed, according to their agreement or partnership deed. So the profits are going to be shared according to that. Documentation, that is an agreement, an oral agreement or written partnership agreement. So what they agreed as partners. Now we are moving on to advantages of this form of business ownership. Now moving on to the advantages of this form of ownership. The first advantage is that partners are able to put their knowledge and skill together to collectively make the best decisions. So they can come up with quality decisions. We can talk about quality decisions that are going to come from the partners. Quality decisions. The workload and responsibility is shared between partners. So now they can share what the workload. Unlike sole trader, that is, the workload is only on him. So here the workload is responsibility and is shared between partners. So they share the workload equally, which is very important and make the work easy and fast. Partners are able to share resources. Truly, they can share what? The resources, which is going to make the business easy to run. Partners are only required to pay tax in their personal and individual capacity. So, unlike in those corporations and companies, they pay tax on the profits of the business. They also again pay tax on the income of the owners. But with this one, only tax is paid on individual capacity. So the partnership itself is not going to be taxed. The organization itself is not going to be taxed. The tax, we only tax what? The tax is only on the partners. And then the members, you can say that. Partnership has unlimited liability. That's the disadvantage. Because now the personal belongings are going to be taken to pay off debts. Each business partner is legally responsible for the joint liability of the partnership. So that is that each business partner is legally responsible for the joint liability of the partnership. So if the business is not able to pay off debts, now it means that is going to be taken from partners with whatever they have. Different personalities and options of partners can lead to conflict. And also, when they are making decisions, that can take what? Time. That can take time. That can consume a lot of time for a decision to be taken because of the conflicts that are going to arise from the members. So that will be also time wasting. Partners may not all contribute equally. So you find some of others are not, of partners are not going to participate. There will be, it may happen that there is no full participation of what? Of the members. So that as well will impact the business negatively when the other members are not contributing, whereby they are remaining with their ideas, of which those ideas were going to be of beneficiary. Now we move on without wasting time. Make sure that we are still together and make sure that we are still on one page. And even the comments are going to be welcome. So moving on, still under partnership, we now talking about the point where it says the partners have a personal interest in the business. So this one is an advantage. It's an advantage where the partners have a personal interest in the business. So they tend to like what? That business. And this helps them to work towards the objectives, goals of the business. Can bring in extra partners at any time. So they can join at any time and that will help the business to grow. Remember, we have said it can be started by 2, no maximum number. So attract prospective employees with the option or incentives of becoming a partner. That is that. But with the disadvantage, loss in profits and the stability of the business can occur if a partner resigns or dies or loses. So you can lose if the other partner is going to die, or is going to resign, or is no longer interested in the business. So it means now we are reducing the number of what? Of partner. Now we are reducing the number of the partners. So that will let the business to lose its profits now, when the number now is becoming small. There can be a lack of capital and cash flow. Now we are moving on to closed corporation. We are moving on to closed corporation. So this kind of form of business ownership, still we are going to talk about number of owners. So here it is going to be started. It can be started by one person to the maximum of 10. What are owners called? They are called members. Amount of capital limited to 10 members contribution. So the capital is limited to 1 to 10 members contribution. Name must be registered and ends with CC. We're going to see the corporation by where the name is ending with CC, which is closed corporation. The reading room, which is closed corporation. Legal status, this one is separate from its owners because we are saying it's a separate legal entity. It's separate from the owners. This one is separate from owners. Separate from owners. So now the liability for debt of the business. Liability for debt of the business. It is limited liability, meaning to say the personal belongings of the members are not going to be in danger. They are not going to be in danger. They are not going to pay off the debts of the business. Only responsible for the capital contributed. So the only responsible for capital contributed. Formation of the business. No new CC can be registered in South Africa after 1 May 2011. No new CC closed corporations can be registered in South Africa after 1 May. But CC can now be converted through the CIPC. Can be now converted into CIPC. We are saying there will be we have said there will be only converted through the CIPC to private company. So one can ask, what is this CIPC? Very important. CIPC is a Companies and Intellectual Property Commission. We are saying it's what? Companies and intellectual property commission. Property commission. So what is this company and intellectual property communication? That is a South African government agency responsible for regulating companies, intellectual property, and other business-related matters. It falls under the Department of Trade, Industry, and Competition. So, like we are saying, no new Cs can be registered in South Africa after 1 May 2011, but CSC can convert through this CIPC to a private company. Moving on, division of profits. Profits shared in a proportion to the member interest in the closed corporation. So the profits are shared in proportion to the member interest in the closed corporation. Documentation, funding statement was required at the time of registration. Now we want to know the advantages as well as the disadvantages of closed corporation. Advantages and disadvantages of closed corporation. The first advantage, there are few legal requirements as only auditing of financial statements or regular annual general meetings. Those are what are going to be required. A CC is a legal entity and has a continuity of existence. So, meaning to say, if the partner retires or dies, the company is still going to continue. So, it's still going to continue. Can be converted to a private company and members become shareholders. That's what we are told that through CIPC, it allows close corporation to be converted to a private company, where members now are going to become what? The shareholders. Members have limited liability, meaning because of they have a separate legal entity. So their personal properties are very safe as the business is separated from its owners. Owners' interest in the CC does not need to be in proportion to their capital contribution. The owner's interest in the CC the owner's interest in the CC does not need to be in proportion to their capital contribution. So this means that distribution of profits, losses, and decision-making authority can be structured, get this straight, can be structured in a way that doesn't necessarily reflect the exact percentage of capital each member contributed. That's what it means when you are saying owners' interest in the CC does not need to be in proportion to their capital contribution. Proportion to their capital contribution. So this simply means that that their distribution of profits or losses, even decision making, can be structured in such a way that doesn't necessarily reflect the exact percentage of capital each member contributed. Also, now we are told that CC may be accepted by CIPC from auditing its financial statement. That's another what the advantage. That's another advantage. This means that the CC might not be required to have its financial statement audited by external auditor, which can reduce cost and administrative burdens. So this can reduce costs. This can reduce costs and administrative burdens. So, however, this exception would depend on a specific criteria or requirements set by CIPs. Now we go to the disadvantages of close cooperation. So the disadvantages of close cooperation says limited growth and expansion since a CC cannot have more than 10 members. So it is limited to 10 members, 1 to 10 members. So that will now hinder the growth of the business. The business is not going to expand. It's not going to grow. Now, moving on, a member of CC can be held personally liable for the losses if the close cooperation, if the member acts incompetent. So a member can be held personally liable for the losses if he is not competent enough, if he is not delivering in the workplace. So that's the disadvantage of being the member of the corporation. If ever you are not going to work hard, you are not going to contribute, that means that you are going to be now liable for the losses of the close. A member of those groups can be held personally liable for the losses. Now we are moving on. We are moving on where it talks about audited financial statements may be required when applying for a loan. So which is going to be now additional costs. Which is now going to be what? Additional costs. It's going to be additional costs. Additional costs can be expensive, and cost of hiring the auditor might be a significant burden for a small business like a closed corporation. So now they are going to have to pay what? The auditor. So if they want to apply for a loan, now they have to do what? They have to now hire an auditor. Now that will make them to pay for external auditor. A CC is taxed if it were a company, which may be higher than personal tax. CC is taxed as if it were a company. So they are taxed like they are a company, and they are very small businesses compared to companies, but they are taxed like they were a company. So you see, that's a disadvantage again when it comes to them. Difficult for members to leave the CC, as members must agree to dispose for personal interest, because now the consensus required. This is where we are saying now it is going to be difficult for a member to leave. It's going to be difficult for a member to leave the closed corporation, as members must agree to dispose of members' interest. So what if they disagree? So you see, it's a problem. That is why we are saying the consensus is required. All members must agree on the disposal, which can lead to difficulties if there is a disagreement. So if they disagree, now this can lead to a problem. We cannot just leave. Now we have to sit together, because we are told that all members must agree on the disposal. That is why I am saying a consensus is required. Consensus is required. So it means there must be an agreement of other members. So if they don't agree, that's when you see it's going to be a challenge. A CC is taxed on its income and standard tax of company based on members' dividends. Based on members' dividends. So that means that a closed corporation is taxed as follows: tax on CC income. The closed corporation is taxed on its taxable income at the company tax rate. So that is that. It is also taxed on members' dividends. When the CC distributes dividends to its members, the members are taxed on these dividends as part of their personal income tax. So that's the disadvantage of closed corporation. That tax on members' dividends. You see? Tax on members' dividends. When the closed corporation distributes its dividends to the members are taxed on those dividends. Members are taxed on these dividends as part of their personal income tax. So that is what you are trying to say. Now we are to move on to the private. You are to move on. Okay. This is the end of the presentation. Hope we were together from the start of this presentation. Okay, sorry. Okay, sorry, good people. We are still having public, limited, as well as the private. So now we are going to talk about the public limited company. We are going to talk about public limited company. So with this one, still we are going to talk about the number of owners. We're going to talk about the number of owners. So the public limited company, the number of owners is 1 to more shareholders. Can be formed by one person to more shareholders. So it means there are no maximum. There is no maximum. What are the owners called? They are called shareholders. Amount of capital. Shares are sold to the public through Johannesburg Stock of Exchange. So that's how the shares are sold. They are sold to the public through Johannesburg Stock of Exchange. Name requirements. The name of the business ends with LTD. Very important. That's how we can notice a company. Legal, it is separate legal entity. It means the business is separate from its owners. Liability for debt, limited liability. So as the business separate legal entity, so it means the business debts are going to be paid by the company, not the owners of the company. Formation of the business. All companies must register the companies with must register with the Companies and Intellectual Property Commission, CIPC. Division of profits. Profits shared in the form of dividends in proportion to the shares held. So they're going to be shared in the form of dividends in proportions to the shares held. So this one, there are documentation that are required under this, which is Memorandum of Incorporation. Which is Memorandum of. One can ask, what is a Memorandum of Incorporation? So a Memorandum of Incorporation is a document that outlines the structure, rules, and governance framework of company. So it serves as the company's constitution and defines like company's purpose and powers, share capital and rights, governance structure, roles and responsibility of directors as well as shareholders. So that's the memorandum of incorporation. Now we are moving on to the advantages as well as disadvantages of a public company. They are saying the business has its own legal entity. The business has its own legal entity. That gives it what? The advantage. Easy to raise funds for growth through the sale of shares. So remember, the shares are transferable. Also, remember that this business is formed between one person and more shareholders, no maximum. So that ensures the growth. Shareholders is only liable for the amount which is invested. So it's only liable for his or her investment. Can appoint a knowledgeable board of directors. So they have a capacity to appoint someone who is very equipped with knowledge, very competent director, which can take the company far. Buy and sell shares freely. So they buy shares, they sell them freely as well. Shareholders can sell or transfer their shares freely, unlike in a private company, because shares are privately owned. The public has access to the information, and this could motivate them to buy shares from a company. That's true. The public has access to the information. Additional shares can be raised by issuing more shares or as well as debentures, and that will enable the growth. Now we are quickly going to the disadvantages of a public company. Must disclose all financial information. So that is a drawback. That is a disadvantage where now they are forced to disclose all their financial information. Where now they are going to expose their financial statements to the public. Large amount of funds are spent on financial audits. So their books are audited by external auditors. So meaning they are to part ways with their profits because those auditors need to get paid. So these are the costs that now are going to be incurred by public company. Stocks have to be traded publicly. That's true. A full report must be submitted to the major shareholders each year. So there is a report that needs to be drawn, which is now an extra week. Difficult and expensive to establish as the company is subject to many legal requirements. Like we've talked about the documentations that are even required as well. So it's difficult and expensive to establish. So the company is expensive to establish, unlike these other forms of ownerships like sole trader, partnership. Those ones are easy to establish. The more shareholders, the less profit. So if there are more shareholders, it means now they have to share the profit. So the profit becomes what? Less. Shareholders may be allowed little or no input into affairs of the company because theirs is to wait for their own level for the amount that they invested. So you'll find that they are not going to be allowed to give their opinions or their ideas or to have any input in the running of the company. That's the disadvantage of being in the public company. Due to legislation, decisions take longer and there may be disagreements. So decision takes longer to be implemented. So there will be a lot of conflict, a lot of disagreement before the decision can be taken, which is going to be time consuming. Now we are moving on to the difference between private and public company. May not offer shares to the general public. We know that the private companies' shares are privately owned. They cannot be offered to the general public company. Shares are not freely transferable, unlike in the public company. Minimum of one director, unlike in the public where they can have as many directors as they can because of them being big companies. The name must end with PTY, proprietary, as well as limited. That's how we can be able to notice that this is a private company. Annual financial statements need to not be audited and published. Annual statements need to not to be audited and published. So it means there are no costs that are going to be incurred by this type of company. If there are no audition, there is no audit that is going to take place. Does not need to publish prospectus as it cannot trade its shares public. So that is that. But with this public company, trades its shares publicly on the Johannesburg Security Exchange. You know that. They are traded on Johannesburg Stock Exchange. That's where their shares are traded. Shares are freely transferable. Minimum of 3 directors. So but with private, remember it's just one director. Name must only end with Ltd, limited. Annual financial statements need to be audited and published, unlike with private, where they do not need to be audited. Have to register and publish prospectus with companies and intellectual property, which is CIPC. So those are the difference of private company as well as public company. Those are the difference between the two companies. Now we are to talk about the impact of a private company. The impact of private company. Advantages as well as disadvantages. Advantages as well as disadvantages. With private company, more opportunities to pay less tax. With private company, more opportunities to pay less tax. We are now talking about the advantages or the impact of private companies, where we are going to talk about advantages or disadvantages of this form of business function. So the advantage is in they pay more opportunities to pay less taxation. Here we are talking about tax benefits. Tax benefits because potential opportunities to minimize tax liabilities. There are potential opportunities to minimize tax liability under the private company. Good long-term growth opportunities. So here we are talking about long-term growth. Talking about long-term growth, whereby we are talking about suitable structure for long-term business. Suitable, this one is a suitable structure for long-term business growth, the private company. Own legal identity and shares holders have limited liabilities. We're talking about a limited liability, where we are saying shareholders have limited liability and protecting their personal assets. This enables their personal assets to be protected. So now we're talking board of directors with expertise can be appointed to take expect decision making. So here we are talking about expert decision making. Expert decision making. Ability to appoint a board of directors with relevant expertise. That is what it means. So now we are told that we're not required to file annual financial statements with the CIPC. So the company has its own legal identity, allowing it to enter into contracts and own assets on its name. So, and also we are told that the new act forces personal liability The new act forces a personal liability or on directors who normally participate in carrying out business in reckless or through the fraudulent manner. So that is that. Also, financial statements are private and not available to the general public. So it gives that private company an advantage because their financial statements are not going to be exposed to the public. A company has continued existence even if the one member can retire or dies but the company is still ensured to continue. It is possible to sell a private company as it is legal entity in its own right. Now we go to the disadvantage. Requires a lot of capital. So unlike with sole traders, partnership, when it comes to this type of of business, the capital designated is a lot. The more shareholders, the less profits, like they've said, because now they are to share the profits that they see. More taxation required, because now they pay more tax. They are big company. Directors do not take personal interest, so they're not going to run the business on their personal interest. Annual financial statement must be reviewed by a qualified person, which is an extra expense to the company, because now the company is going to incur what expenses, because they are costs that they are going to incur by paying that expert person. Difficult and expensive to establish, as the company is subject to many legal requirements, same as what? Same as a public company, because there are also documents that are needed. Pays tax on the profits of the business and declared dividends. So they pay tax on the profits of the business and also on a declared dividend. They are to pay the dividends to shareholders. Must prepare annual financial statement also. So this is the end of the presentation. Thank you for your time. Thank you very much for your time. Make sure that you are going to read this presentation from the start to the end. We're going to go through it and comment on it in a constructive way. Also, make sure that you share with those who are concerned.